Hello traders, today I'm going to show you how to use indicators on a chart and which indicators you don't need. Let's get into it. So let's start with our first tool, simple moving average. I already have them here, the 20 simple moving average, the 50 and the 200. You can see them on the left, on the top left. Here on the chart, the 20 simple moving average is the red line, the 50 is the blue line, and the 200 is the yellow line. So what actually this moving average are telling us? So the 20 simple moving average is the short-term trend. So the 20 tells me if we are in an active uptrend, like we are here, or we're losing momentum. So if the stocks start moving below it, we are losing momentum. It's the line the institutional buyers tend to defend in a healthy stage 2 uptrend. The 50 simple moving average is the intermediate trend filters, so around 3 months, a quarter. The stocks that hold above the 50 simple moving average are still structurally healthy. The ones that are moving below the 50 simple moving average are definitely in a downtrend, and they're not anymore strong. So they're weakening. As soon as the stocks start moving below the 50 simple moving average, most of the time is the beginning of a downtrend. Now, though, if you see a pullback to the 50 and a bounce, that's one of the highest probability trades in swing trading. Now, very important moving average, and where institutional buyers are really looking at, is the 200 simple moving average, the yellow line. That separates a stock in a long-term uptrend from one that's phasing or topping or reversing. So I don't touch anything if I want to be bullish, if the stock is below the 200. And also, there are not many institutional buyers behind the stock if it's below the 200 simple moving average. I'm bullish only if I see the price above the 200, that's for sure, and above the 50. So this three moving average will tell you the trend on 3 different time frames. But that's a lot already for you to know before you even decide to enter a trade, because you would know if the price is above all the averages, you can go long, and if it's below the averages, it's better if you go short. Don't fight the trend. Now, a second thing, and this is non-negotiable, is the volume. So volume, it's something that you always need to have on your chart together with price, because the price tells you what's happening, and the volume tells you if anyone actually means it. If actually there is buying or selling, significant buying and selling behind the move. So if I have a breakout, for example, if I have a breakout here, like it happened, with high volume, I know that this move is confirmed. There's somebody behind the move, and I can trust it. In fact, it kept moving higher. Now with this particular stock is just facing, but it didn't fall apart, did it? And if I had a move to the upside or break with low volume, I don't have the confirmation that I need, and I'm definitely not going to go long. Now, there can be pullbacks, like for example, this example here. But again, volume will help us, because if I see a pullback, this red candle going down, bouncing on the 20 SMA, and the volume is drying up, there's no high volume, I'm more confident that this is just a short pullback, and a move to the upside will resume. So that's really, really important. And I look at volume on breakout days, but I look at volume also on distribution days, because distribution days with high volume is telling me that big players are quietly selling into strength. So that's the subject for another video. Now, another indicator that a lot of people like to use, the RSI, the relative strength index. You have it here, the purple indicator with the purple line. So many people use this wrong because they're trying to predict reversals with this, based on the fact that the RSI, you can see here, we have 2 lines, one at 30 and one at 70. Usually when the line goes above 70, we call the stock overbought. If the RSI instead moves below 30, we think that we call the stock oversold. So usually people, what they understand and what they do is they see overbought condition, they think a reversal might happen, they sell the stock. Or they see an oversold condition, they think that the stock is bottoming, right? And they think, okay, it's time to buy. Well, that's not true, because many times the other side could go oversold and the stock keeps moving down. Same for moving higher. If the RSI gives us overbought condition, many of the times the stock keeps going higher. So it's not good to use for reversal. You use it to gauge momentum and spot divergence. So if its price is making a new high, but the RSI is making lower highs, that's a momentum warning, and you need to pay attention to that. But if I see instead the RSI moving higher and the stock moving higher, we still have momentum behind the move. So don't use the RSI to predict reversals, because that's not the way you should use it. Now, the ATR instead, the red line you see here, average true range, isn't a directional indicator, and it doesn't tell you where the price is going. It has nothing to do with that. It tells you how much the stock typically moves. So this stock in this example moves $2.67 per day. That's very useful because that's what you need for two things. Number one, setting the stops that make sense for the stock normal volatility, and sizing your position so a normal move doesn't stop you out for no reason. So if I want to enter this trade, for example, and I know that the stocks move $2.67 a day, and I place a stop at 54.90, you can also visually see by yourself that it's too tight, but sometimes it's not that obvious on a chart. It's easier for me to get stopped out because I know that the stock moves per day $2.67. So I'm not going to put my stops at $2 because I know that for normal volatility, the stock could easily get there. Now, to the upside, I know that for this stock, it would be easy to get to 58 or 59 because it's at 56.39 and the stocks move $2.67 per day. It's just an easy move. Okay, now let's talk briefly about what I don't use and why. So if you go on indicators, you see names like commodity channel index, moving average, convergence, divergence, the famous MACD, stochastic indicators, Bollinger Bands, and the list goes on. There's so many indicators. Almost every one of these is a mathematical derivative of the same two inputs, that is price and volume. So there's no need to add these other indicators. You really don't need it. When you have the indicators that I already showed you on one chart, you have more than enough. Honestly, you could literally trade only with price and volume if you want to. So don't need to add so many indicators to your charts. You're just going to clutter your brain and your chart. What I show you is more than enough. More than enough. You could even like not use the RSI and just use moving averages and ATR for your stops. So that's really all you need. If you want to see how I break down trades and how I use price and volume together for my trades, you can join my coaching session. The link is in my account. And I'll see you next time.